is to really cut through the noise on what's become a major standoff in economic policy. We're talking about the conflict between the U.S. Treasury Department and the Federal
A
Reserve.
really high-pressure situation.
Exactly. We're diving into the sources you've shared, and they all point to one big question. How fast should the Fed be cutting interest rates? Now, you might think this is, some obscure debate for bankers.
Far from it.
Our sources show it's anything but academic. You have the White House's political goals on one side, and on the other, the Fed's, let's say, institutional caution. The administration, speaking through the Treasury, is basically saying that lower rates are the single missing piece for the economy to really take off. But the Fed, they're pumping the brakes, keeping a very, very close watch on inflation.
And that tension is really the core of what we're talking about today.
Yeah.
You've got the fiscal side of government treasury, spending, taxes, telling the monetary side, the Fed, that they're the only thing holding the economy back.
Yeah.
And look, this isn't just theory. The outcome here is going to shape the cost of your mortgage, whether businesses are hiring, the price of groceries in 2026. It's that classic trade-off, growth versus price stability. But it's playing out under this intense public spotlight.
Okay, let's unpack this, and let's start with where all the heat is coming from. The main source on the administration side is a recent speech from Treasury Secretary Scott Bessent. He was speaking to the Economic Club of Minnesota. And what's really striking about it isn't just what he said, but how he said it. It felt like a very calculated, very public shot across the Fed's bow.
It was an incredibly bold move. His core argument was, it was totally uncompromising.
Yeah.
He said, and I'm quoting here, that lower interest rates are the only ingredient missing for even stronger economic growth.
Wow.
That one line, that's a powerful political statement, because what it does is it tries to shift all the responsibility for what happens next away from the White House and puts it squarely on the Federal Reserve.
And the subtext there, it's just so clear in the source material. When he says it's the only missing ingredient, he's implying the White House has already done its part. Their side of the bargain is complete.
Exactly. He's saying fiscal policy has done the heavy lifting. Now it's time for monetary policy to get with the program. For you listening, that distinction is just so crucial. Fiscal policy is the government's tool, taxes, spending, regulation. Bessent is arguing that foundation is solid.
Right.
Monetary policy, which the Fed runs, is about the cost of money, interest rates. So the Treasury Secretary is basically throwing down a public gauntlet. He's saying, we did our work, now you, the Fed, have to finish the job.
And to back that up, he listed some specific achievements from 2025. He brought up the One Big Beautiful Bill, which was all about infrastructure, clean energy subsidies, bringing manufacturing supply chains back home.
A massive spending package.
Yeah, huge. And he also mentioned new trade deals, the big deregulation push. So the administration's story is that all this work has set the stage perfectly. The economy is primed, the America First seeds are planted, and now the Fed just needs to provide the water, the cheap credit.
Right.
So that 2026 can deliver on all those promises of growth and, benefits for the average person's wallet.
But that framing, it treats the central bank like it's just an unnecessary handbrake, not an independent stabilizing force. It completely ignores the Fed's dual mandate, which forces them to balance maximum employment with stable prices. Bessent's argument just prioritizes the growth side above everything else, which is, by its very nature, a political stance.
But let's play devil's advocate for a second. If the economy is fundamentally strong, why should the Fed keep rates high? Isn't their job to support the economy when the inflation risk has gone down?
That is the absolute heart of the debate. And to your point, you have to acknowledge the Fed has already acted. Our sources are clear on this. In the last 4 months of 2025, they cut rates 3 straight times, a total of 0.75 percentage points. They weren't just sitting on their hands.
And those cuts brought us to where we are now, with the benchmark rate, that's the rate banks charge each other, in a range of 3.5% to 3.75%.
That's right. And to really get the significance, you have to remember the context. That range is a huge pivot from the really tight, really restrictive policy they had for years to stamp out that inflation spike.
They were aggressive.
Incredibly aggressive tightening the screws. And then, as inflation started to cool, they were pretty aggressive loosening them late last year.
Okay, so if they've already moved, why is there a fight now? It seems like it's all about the future pace. The sources show things are slowing down dramatically. Financial markets are now only pricing in, 2 small rate cuts for this entire year.
And maybe not even that.
Right. And the Fed's own projections, the ones they release themselves, hint at maybe only 1 cut.
And that gap, That's the whole story. The difference between 3 cuts in 4 months last year versus maybe 1 or 2 for all of 2026.